Hello, and thank you for joining us at xm.com for this Forex Preview video. We'll be looking at UK inflation. The United Kingdom, of course, has been plagued by political drama these past few weeks, and the latest CPI data for September out on Wednesday is unlikely to offer any calm to the markets. I'm Cristina Marujos. Joining me today is our senior investment analyst, Haralambos Pissouros. Haralambos, inflation expectations have ticked up, and speculation is that we will get a double-digit number again on Wednesday. How could that affect the Bank of England's policy at its next meeting?
Hello, Christina. Yes, indeed, inflation in the UK is expected to have rebounded and hit double digits again. Specifically, the headline rate is forecast to have ticked up to 10% from 9.9%, with the core rate expected to rise as well to 6.4% year over year from 6.3%. In my view, this implies that the rise in the headline inflation may not be only due to volatile and temporary items. In other words, a rise in core inflation rate means that inflation is becoming stickier in the UK. Now, with regards to the Bank of England, following the market turmoil caused by the government's mini-budget announcement in September and the bank's emergency bond buying plan, investors were largely convinced that the bank will hike by a full percentage point or even more at its upcoming gathering on November 2nd. However, with the new Prime Minister replacing the Finance Minister and the newly appointed Finance Minister scaling back most of the announced agenda, investors took some of their 100 basis points bets off the table. The Bank of England ended its emergency program on Friday, and the government's U-turn suggests that it may not need to come to the rescue again soon. That's maybe why the probability for a full percentage point hike has slid to around 60% today. Having said all that though, accelerating inflation in both headline and underlying terms could well prompt investors to add again to such bets and expectations. After all, the Bank of England's primary mission is to control inflation, and in this case to bring it back down to its 2% target.
Now let's turn to the pound, Haralambos. It has recovered from its record lows, but it's still struggling. What is the outlook for sterling, though, moving forward in this environment of political unrest, especially with recession worries intensifying?
Now, in my opinion, even if the pound recovers a while more, the outlook remains blurry. Yes, in politics we are back before the announcement of the mini-budget, but we do still have to wait for the official announcement of the government's fiscal plan on October 31st, while some conservative lawmakers have expressed the desire to submit letters of no confidence in the new Prime Minister. So there is still uncertainty in the political landscape, and uncertainty is not good for a currency. Moreover, and more importantly, even if the pound trades higher in the aftermath of inflation due to rising expectations of a bold move by the Bank of England, recent history has shown that pound traders are more concerned that bigger hikes by the Bank of England will only assist in dragging the UK economy into recession rather than relieving their pockets from the pain of high consumer prices. And with the UK economy, as you already said, on the verge of recession, it probably already contracted during the third quarter. Those fears are more than rational. This, combined with the pound's risk-linked characteristics developed due to the UK's twin deficit, could keep a lid on the currency and perhaps result in another round of selling in the not-too-distant future. Now, despite investors' appetite improving the last couple of days, major central banks around the globe are still tightening aggressively in order to bring inflation to heel, but at the cost of slowing global growth, which implies a still fragile broader sentiment, and another risk-off episode could well weigh on the British currency.
Haralambos, thanks so much. This was a Forex Preview. Thanks for joining us here at xm.com.